Let's take a look at how well the inverted yield curve predicts recessions and the reasons why. Because it's risky to wait a long time before getting a loan paid back to you, normally you and the borrower will agree on lower interest rates for shorter payback periods and higher interest rates for longer payback periods. All interest rates in the country are benchmarked to government bond rates. So for example, if the 3-month government bond rate goes up, the interest rate for all 3-month loans in the country should go up too. That's why we focus on government bond interest rates to know the direction of all other interest rates in the country. So a yield curve plots interest rates of short maturity and long maturity government bonds. Here, the shortest maturity bond is for 3 months, and the longest maturity bond is 30 years. From left to right, payback periods are for 3 months, 2 years, 5 years, 7 years, 10 years, and 30 years. Normally, shortest duration money should pay the lowest interest rate, and longer duration bonds should pay progressively higher interest rates. So a normal yield curve slopes upward, as can be seen here. Throughout this video, I'll focus on the 10-year interest rate minus the 3-month interest rate, since these are the interest rates used by government officials to determine if the yield curve is normal or inverted. When the 10-year minus the 3-month is positive, as shown here, there's a normal yield curve in the markets, since 4% minus 1.8% is positive 2.2%. The long-term interest rate essentially is greater than the short-term interest rate. But an inverted yield curve, indicated by the blue line here, slopes downward. The shortest duration loans have the highest interest rate, and the longer duration loans have the lower interest rate. So when the 10-year rate minus the 3-month rate is negative, the yield curve slopes downward and is an inverted yield curve, since 2% minus 6% is negative 4%. The long-term interest rate is less than the short-term interest rate. This doesn't happen often in financial markets, so it's something worth looking into. Now this graph here goes from 1968 to 2022. And you can see why the inverted yield curve is believed to predict upcoming recessions. It shows the difference between the long-term 10-year interest rate on bonds minus the short-term 3-month interest rate. The shaded green area shows when the 10-year rate is greater than the 3-month rate, which is when a yield curve is normal. So 10-year minus 3-month is a positive number in the green section. The shaded red area shows when the 10-year rate is less than the 3-month rate, which is when a yield curve is inverted. So 10-year minus 3-month is a negative number in the red section. And finally, the horizontal black lines show periods when there was a recession. You can see that the inverted yield curve often precedes recessions. And currently, on the far right, we can see that there is a considerably large inversion of the yield curve that first inverted in 2022 and has stayed inverted since. In fact, this is the largest inversion of the yield curve in the last 40 years. By the way, some investors and economists compare the 10-year rate minus the 2-year rate instead of the 10-year rate minus the 3-month rate. But the results for both methods show almost the same pattern of inverted yield curves preceding recessions, so it doesn't really matter which rates you look at. So let's try to understand why a yield curve inverts and what effect this has on financial markets, the economy, and investors. A good place to start is to look at how the Federal Reserve, also known as the Fed, influences short-term interest rates. Raising the Fed funds rate increases short-term interest rates in the economy, and lowering the Fed funds rate decreases the short-term interest rates in the economy. So in this chart, we can see the history of the Fed funds rate increases and decreases from 1968 to the end of 2022. The Fed funds rate is represented by the blue line, and the corresponding rate value is on the left axis. The orange line is the short-term US 3-month government Treasury interest rate. We can see that the short-term interest rate is very strongly influenced by the direction of the Fed funds rate. And we can see how the short-term rate moves in the opposite direction to the yellow line, that is the 10-year bond interest rate minus the 3-month interest rate. By the way, the yellow line is the same image I showed earlier with the green and red sections, but I've made it easier to see here by using a clear yellow line instead so that it can be plotted together with and compared to the short-term 3-month interest rate. So if the yellow line is above the 0% horizontal axis, there's a normal yield curve. And if the yellow line is below the 0% horizontal axis, there's an inverted yield curve. You can see that when the orange 3-month interest rate line increases a lot, the yellow line comes closer to 0% and very often goes below 0%, signaling an inverted yield curve. And as we saw before, a recession often begins after the yield curve inverts. So the Fed funds rate is one of the main factors influencing short-term interest rates, and the yield curve can become inverted if the short-term interest rate increases a lot. So now let's look at how the inverted yield curve affects the economy. An inverted yield curve may create unprofitable banking conditions in the economy. When there's a normal yield curve, banks borrow money short-term at short-term interest rates. They then lend some of the money out at higher long-term interest rates, which earns the bank a profit on the difference between short and long-term interest rates. This money then circulates in the economy, which creates jobs, spending, and economic growth. However, when there is an inverted yield curve, short-term interest rates are higher than long-term interest rates, which makes it harder to earn a profit this way. Banks may become more strict when deciding whether to give out long-term loans if there are reduced profit margins. Additionally, borrowers may have more difficulty paying off loans if the interest rates are too high, or less borrowers may be able to borrow money at generally higher interest rates. With less money generally available, spending may drop in the economy. Now let's look at how an inverted yield curve can affect investors. The inverted yield curve can influence the flow of investor money. For example, this graph shows the change in the yield curve from April 2022 to February 2023. In April 2022, the yield curve is normal, with the 10-year interest rate higher than the 3-month interest rate. But in February 2023, the yield curve is inverted, with the 10-year interest rate lower than the 3-month interest rate. As an investor, you want to move your money to where you can get the best return. In April 2022, S&P 500 stocks paid about 1.43% dividend on their stock prices. This was higher than the short-term 3-month bond interest rate at the time, which paid less than 1%. In February 2023, S&P 500 stocks paid about 1.67% dividend on the stock price. But short-term 3-month and even 2-year bond interest rates have shot up much higher than in 2022. They are now around 4.5% and 4.1% respectively. This means that you could invest your money in a 3-month or 2-year guaranteed bond and make 2% more per year than investing in a risky stock. Basically, an investor could invest in short-term, low-risk bonds and get a higher payout than investing in higher risk stocks. An investor might find it more and more attractive to move their money from low-paying risky stocks to high-paying safe government bonds, eventually pulling money away from stocks and into bonds. In addition, buying stocks with borrowed money, which is called buying on margin, becomes less attractive in a high interest rate environment. Lastly, we could describe the currently inverted yield curve in the following summary. Short-term interest rates have risen as a result of an increase in the Fed funds rate. The rise in interest rates has either already reduced or could reduce the amount of money, level of spending, and consumer demand in the economy. Riskier and lower yielding assets like stocks are becoming less attractive in the face of higher yielding, safer assets like bonds, which may be contributing to the weakness in the stock market. Company managers are currently worried by high interest rates, which make it more difficult to borrow money. And since lower stock prices make their companies worth less in the market, managers are reducing spending on projects, cutting unnecessary expenses, and some are starting to lay off staff. If the economy slows down even more, it's possible that companies will reduce spending even more and continue to lay off even more employees just to stay alive. So the main takeaways from this video are that the inverted yield curve does not predict a recession, but the inverted yield curve does make banking less profitable. It makes borrowing more difficult with high short-term interest rates. It makes the short-term bond investing more attractive. It could make stocks less attractive than safe assets like bonds. And it could make companies cut back on their spending. Undoubtedly, these conditions can make the economy fragile, but do not guarantee that a recession will happen with 100% certainty. So I hope you now have an idea of what the inverted yield curve is and why you should be aware of it. Stay safe and see you next time.